Hey traders, it's Blake Morrow with Trading Analytics. And guess what? I brought Jim Welsh in from Macro Tides. He's going to be talking to us because we have a big day tomorrow. I mean, the Fed's focused on the Fed. The Fed is focused on the jobs report. We're focused on the jobs report. Are we and should we be expecting a big move tomorrow? What do you think?
Well, it's certainly possible. As I point out to people, you got 160 million people working in this country, and 1/10 of 1% of 160 million is 160,000. So right now, I think the street's looking for 85,000-ish jobs. If you get much above, let's say 120, and you get some upward revisions to the June and July number. Remember, they were, I think, revised lower by 258,000. It was the largest revision since 1968 outside of a recession. So you'd need to see that the number come in for August above 120, revisions to the upward revisions for July and June. And conversely, you get much below 50,000, and people will start talking, well, maybe the Fed will do 50 basis points. So, I mean, there's a, window that it falls in, and you're probably going to get somewhat muted. As you go outside that window, obviously, to the upside or downside, you're going to get a bigger move. I mean, that's not rocket science.
Yeah, well, okay, it's not, but we're also getting a big revisions number on September 9th. Is that correct?
That is correct. And I think last week or the week before, we showed and discussed it. Goldman Sachs estimates that it's going to be somewhere between 5 and 900,000 jobs that will disappear. And so, in some regards, Blake, I think that report can be as important as the jobs number coming out tomorrow. Um, if it's in the 5 to 900,000 range, that's a lot of jobs. That's 50 to 75,000 jobs a month going away. Now, as I've pointed out in the last few weeks, oh wow, okay, the shock value of another big downward revision. At the same time, those jobs didn't exist and the economy's still doing what it's been doing. So it's not like, oh, wait a second, oh my God, now that those jobs aren't there, they never were there, the economy is going to go into the tank. I'm saying, in other words, the initial shock value, if somebody stops and thinks about it, is like, okay, that tells us that the labor market's weaker. If you get a very weak employment number for August or any month in the next 3 to 6 months where you've got negative prints, well, that tells us much more about where is the economy heading, not revisions from April of last year through March of this year. That's, really rear view mirror stuff.
Right.
But the number itself, the size of it potentially could be shaky. And you've got the CPI and the PPI coming out again before the next meeting. So there's a lot of data points, and that's why a lot of these folks are still on the fence. The guy from St. Louis, I have to learn his name. He just became president in the last I don't know, 6 months maybe. And his point was, hey, what do we know for certain? Well, we know inflation is closer to 3% than 2, and there's a risk that the labor market might deteriorate. But what do we actually know? So
Yeah.
his take was, you know what? I'm not making up my mind before the next meeting. I'll do that 2 or 3 days before, after I've seen all this data.
That's the Fed president,
Muslim?
your Museum. Yeah. Museum.
Yeah,
Museum.
yeah.
Yeah.
So
It's not
that
museum.
to me is a common sense approach, Blake, doesn't it? I mean, it just sounds like, okay, that's pretty obvious.
Right.
And I'll point out again that Waller, who put forward the idea and dissented at the July meeting, it's like we cut once and then we continue to monitor the data. It wasn't like, well, once we cut, we're going to have to keep cutting. Even he, who, dissented at the July meeting along with Bowman, are like, well, let's take a very measured approach. We'll cut and then we'll see what happens. So anyway, a lot of data. And the jobs number tomorrow. Again, the crazy thing is we react to whatever the number is, and then 6 months later, whatever we reacted to disappears. It's like,
Yeah.
okay.
Well, Jim, tomorrow's going to be a big day, and September 9th might even be a bigger day. So we're all going to be bracing for this potentially massive move. But right now, you brought in a chart that I think is important because it's been the talk of the town. Is you bring in a chart about AI spend, and
Yeah,
it's been crazy, berserko, and I
yeah.
think the question that a lot of Wall Street's asking right now is are they going to get the returns based on, the spend that they've laid out? And I'm assuming you're going to try to build a case here.
Yeah. First of all, in terms of the main prop underneath the market for the last 2 years, with a couple little dips along the way, has been the AI story and the spending. I mean, this year the big four will spend over $300 billion. That's a lot of money. And they're projected between this year and 2030, it'll be like 2.2 trillion or more, with 500 billion being spent in 2030. So an enormous amount of money is being spent. And just to put it in comparison, on the right side of that graph is spending on AI compared to spending on office buildings. Well, for obvious reasons, spending on office buildings has been going down while this is going up, but it's a big number. MIT came out with an analysis 2, 3 weeks ago. I'm pretty sure you and I have talked about it. I know I've written about it, where only 5% of the people who are employing AI are seeing any results. So, to your point, in terms of, okay, they're spending all this money, when are they going to get a return? What that MIT study said, they aren't getting a return. And so, right now, that will change probably, but there's like this mad rush in this competition where everybody has to feel like we better spend a lot of money or we're going to get left behind. And at some point in time, I think, to the extent that that MIT report captures what's been going on, is the adoption rate is high, the return on investment has been incredibly low. At some point in time, even when the business cycle turns, where we actually do see a slowdown that heads us into a recession, well, that spending is going to get cut back.
Yeah. Well, Jim,
It's the way it works.
it does smell a lot like the internet bubble in a sense that I remember back in the day everybody was blowing and going, spending money and investing money into the internet, and it yielded nothing. Now, obviously, you fast forward 25 years later, it's changed. To 30 years later, it's changed the way that we do everything, and AI, I'm assuming, is going to be a very similar trajectory. But that doesn't mean that we're not in a bubble and we're not getting this overspend that similar that we saw in 99, 2000,
Yeah.
2001. And really Wall Street's gonna, start to take notice when they're not, the companies that are these unicorn type of AI companies aren't generating any capital, or B, the spend comes to a screeching halt and Wall Street goes, wait a second, maybe we got a little bit over our skis here.
That's coming. Yeah, I mean, that's the way the cycle, and they've always, you and I have talked about RCA in the 1920s,
Yeah,
about the prospect for not just radio stations all over the country, but they were going to start sending like pictures so you could actually see somebody, right? Unbelievable. Well, RCA went from like $15 to over 500 back to 15. And did they realize that, did we get TV stations all over the place? National Broadcasting Company, that's where RCA morphed into NBC. Absolutely. So you get to that point where the hype it runs way ahead of what's actually going to happen, so, to the point that when what people were betting on actually does happen, the stocks lose 50% of their value because the
right.
hype money is no longer there. So we're going to look at the semiconductor. So I'm going to try to tie all this stuff together in. So the next chart looks at garbage in, garbage out. So I saw this, I thought this was amazing. So all these AI models get data from somewhere. Well, this is saying 40% is coming from Reddit and YouTube and so on, so that if you have garbage in, you're going to get garbage out. So my point is the credibility of some of the data that these models are relying on, especially in the world that we live in today, where people don't always tell the truth. They're more willing to make a political point, or if they can. So this to me is one of those, I don't want to say Achilles heel, but obviously a potential weakness in terms of the output that they're going to generate. And I think this is probably one of the reasons why, the return on investment hasn't been all that great because some of the input data, um, may not be completely accurate or critical.
Yeah. Okay. All right. Well, that's really interesting. I could type anything on Reddit and there it's picked up by AI and it becomes fact.
Yeah,
You
yeah,
know.
irrespective. So semiconductors has been the group that's obviously been front and center of the AI, with NVIDIA being the general leading the charge. And this chart is interesting. In 2000, at that bubble, semiconductor stocks were about 7% of the S&P. What you can see is within a couple of years, that was down closer to 2%. So you talked about, what, about a 65% decline from that high 2 years later.
Yeah.
Now we're up to almost 12%. So the point I made in a recent letter, the September Macro Tides, is if you go from 12 just to the high in 2000 at 7%, that's like a 45% decline. That doesn't even factor in potentially companies cutting back on spending, earnings starting to get crimped because, hey, we went into a recession, everybody cut back. So the point I think is it's always key to have a perspective. Where are we? On the bigger picture standpoint, as opposed to, I think I probably mentioned, almost every day they're doing 60 million options on stocks and indices. In the last few weeks, Blake, more than 60% of the volume are options that expire in one day. All right. So obviously, perspective, this chart means nothing to those people. If it's moving and moving up, I want to buy a call option.
Right.
And so for the rest of us, I think it's important to say, okay, let's keep our feet planted on the ground. Go with the flow in the near term, but don't be fooled that this is some kind of a magic bullet that's going to solve all the problems of the world. They're going to go through a challenging shakeout period when this, stampede to spend as much money as possible on AI starts to reverse, and it will.
All right. Well, that is a really, really interesting chart. Let's talk about this next one.
Yeah. Well, all this stuff goes through cycles where people get extraordinarily excited. There's obviously a legitimacy. I mean, our Microsoft and Nvidia and Apple and Amazon are these all companies that are legitimate? They're cranking out enormous amount of cash flows. So that's one of the big differences with 2000. There were a lot of companies that weren't making any money, but they were selling at 100 times sales. So there's always a narrative that's credible. That's how you can justify getting all hyped up. And then the other part comes with the stocks are going up like crazy. I want a piece of that action.
Yeah.
But the rest of the cycle goes through then the disillusionment where, gee, they're not making the money we thought they were as quickly. Sales volume instead of being up 50% is only up 5. I mean, that's what's coming. It's the nature of the beast. And to me, this is puts it in perspective in terms of this is what's happened. Eventually, you're going to realize much of what people are overpricing today, but you go through this disillusionment where it didn't happen as quickly. Stocks start going down and then it cascades. And
Sure.
is all that's coming. It's that simple.
All right. All right, doom and gloomer.
I'm not
Tell,
done.
no,
A little
I'm gonna
realism
go.
here, man.
I'm gonna go.
Well,
I don't know what I'm gonna
there
do.
should be didn't I send you a semiconductor chart?
You
I think.
did? Is it? Oh, is this?
Yeah,
Here we
yeah,
go.
the
Sorry.
there you go.
Sorry.
So, a couple weeks ago on August 21st, you and I covered the semis, and I was noting that, hey, it was making a new all-time high and the RSI was diverging. My expectation was a decline to 280. It then dropped very quickly to 281. And I just think the probabilities, Blake, given the RSI divergences and the panel on the top is the semiconductors relative strength to the S&P. If you go all the way over to last summer, June and July, you can see that as the SOX was making new highs in July, the relative strength was starting to weaken and then it rolled over. Well, look at where we are now. We made a new high. It didn't confirm it. It's rolling over. So, on a relative strength standpoint, this says that money is already starting to come out of this stuff. And I think NVIDIA, I mean, they came out with a good report. And, my, advice was watch how the stock trades. If it's good numbers and it doesn't go up on that, that's going to be a problem. And so for me, the conclusion I come to, Blake, is I think it's a question of when, not if, the semiconductor index is going to close below 280. And if it does that, the next stop is close to 260, 265. If you look off to the left, you can see a whole bunch of highs, 262,
Yeah.
62. That just would be normal chart stuff. Just get back there. And at that point in time, the RSI will be under 40. Maybe it'll be approaching 30. So if this leading group, which has kind of been pulling the rest of the market up because of the weighting in the S&P, falters by another 6 to 7% decline, then I think the S&P, and we're about to show the S&P next. I think that the S&P is going to have a deeper correction. Now, I think there's a shot that we're going to see the S&P get above the recent high at 6508.
Yes. Complete wave
Yes.
five.
I just think that if that happens, and look at the bottom panel, that shows how many stocks are participating at this point in time compared to a month or two ago. It's a lot weaker. That's like what kind of thrust are we getting? And that's saying not a lot. And so for me, like getting above 6508, I think opens a window to go short because I do think the S&P is going to decline below 6343 and potentially make a run at 6200. So if the semiconductors break down, that's going to bleed through to the S&P. And that's why, we're not talking the end of the world here. We're talking about a 3 to 5% correction, you know? So
I just tuned out. I just tuned out.
you only want to see up, up and away.
That's right. I want to see death and destruction or send me to the moon, Alice. I don't, that's what I'm in for.
Yeah, yeah.
All right,
So
Jim.
the
Well, you
fifth,
squashed
the
my
fifth dimension.
you
This is
squashed
before your time. The fifth dimension,
fifth
man.
dimension. All right. Well, you
Up,
squashed
up and away.
my ideas of high volatility. All right, so let's talk
Okay.
about treasuries because just everybody was talking about the 30-year yielding 5%, and then all of a sudden,
Yeah,
next thing you know, yields came right back down earlier. You
yeah.
can see we're right back down to support. So what happens with yields here?
I still, my take has been is I think we're going to take out the 418.8, from 2, 3 weeks ago. And we did take it out by obviously a very small amount. Two legs. I have C equals A at 407. You went from 462.9 down to 420, back up to 449. You subtract 22 basis points from 449, you're at 407. So I still think there's maybe a little bit more downward pressure coming on treasury yields. The 30-year might get below 470, maybe. It's been lagging terribly because something we've talked about. Global yields are going up in Germany, Japan, United Kingdom. And this is something I've written about in the sense that all these countries are going to be selling more bonds. And the US is going to be selling a lot of bonds. And now all of a sudden, we're all going to be competing for global capital flows. And one way you compete is if yields go up, you attract more bidders. And I think that's part of what we're seeing. So my take has been we get this last decline in treasury yields. Once it's over, I think the 10-year is going above 5. The 30-year will go above 515.
Okay.
So I'm looking at just one more little dip. Maybe the employment report comes out tomorrow. It's a little softer. People, well, maybe the Fed will cut by 50. That might be enough to pull the 10-year and 30-year down a little bit more. But again, my take here, Blake, is we're nearing what could be a pretty major inflection point in the Treasury bond market.
Well, speaking of, you're, pulling out your forecasting, palm reading skills, we got the dollar, which is facing, obviously the jobs report tomorrow. So how do you see this dollar as it's wound up really tight here?
Yeah, I think we're going to go down. I mean, as we made the low at 96.37, I was pretty bullish. I'm like, hey, we're nearing a low here. We got a three-wave rally up, and then once the pullback from 100.25 overlapped that initial high at 98.95, well, then it can only be a 1-2-1-2, and then you better really take off. And 2 weeks ago, I said, if it doesn't take off, then that increases the odds we're going to go down to a new low. We didn't get the takeoff. So as long as we're staying below 100.25, I think the odds are we're going to take out 96.37. And then I think you've got a major low that's going to form there. It ends the correction that began in October of 2022 when the dollar was above 114.75. So we're talking a multi-year sideways to down correction that I think ends on one more decline. And interestingly enough, gold bottomed in September of 2022, just as the dollar was making its high. And my take, and we talked about gold last week, and the point was when Blake changes the chart to
Oh, here we
gold.
go. Sorry. I was still focused on my strategy and the dollar for tomorrow. Okay, go ahead.
Yeah. So when we were talking last Thursday, gold was trading above 34.03. And in the Monday weekly technical review last week, I said it gets above 34.03. That's the signal that the rally to a new all-time high has finally begun after this sideways chop. And we've seen a very powerful move. I think the odds are gold will trade above 3,600. You can see the RSI is already comfortably above 70, so it's pretty overbought. But gold can make moves. In other words, there's no divergences there. My take is that given the rush into gold, you just had a breakout after a 4+ month sideways chop. I think there should be some additional follow through that will get us higher above 3,600. And at some point in time, we'll probably see a high where the RSI doesn't confirm it. And that'll provide, a message that, all right, it's running out of gas. If I'm right and the dollar goes and makes a new lower low, Blake, you would think that would be a tailwind behind gold. And does that open the door to 3,700? Maybe. Maybe it does. The bigger picture point I would make is, for months, I was like, we're going to get this correction in gold, and then we're going to go above 34.96 in wave five. We're in wave five from the low, I believe, in September of 2022 at 1616.
So the question
So
is, how far is wave five going to be? Where's
yeah,
this going to be?
in gold, fifth waves in commodities sometimes to go nuts. So, to me, I'll be looking at the 5 and 13 moving averages, other short-term indicators. But to me, I just think near term we're likely to go higher. The dollar does take out recent lows. You got to think that gold's going to like that. But once this rally in gold is over and the dollar bottoms, as I think, we're going to see a major correction in gold.
Okay.
We're talking 20 to 30% type correction in gold because I think the dollar is going to have a fairly significant rally. We're not there yet, but from a bigger picture standpoint, that's, I think, the way it looks like it's setting up.
Wow. All right. Well, that's scary. I mean, it's scary to some people, that have been, I mean, I don't know any gold bears out there. So,
That is another issue. All of a sudden, everybody's hopping on the train. And that, again, with the fifth wave in commodities, they can be really powerful. You get a blow off is kind of what happens. So, um, I would be inclined above 3,600 to take something off the table, and then at 3,650 take something off the table until you get some kind of a price reversal. At some point in time, like it'd be helpful if there's a key reversal, where you go a little sideways, you get a spike up maybe on news to higher highs, and then it takes out the prior 2 days lows. That would be, I think, a good signal to become more aggressive in terms of lightening up.
Well, the great thing is, a subscriber of Jim's Macro Tides, he gives special updates throughout the course of the week. Sometimes when there's special situations that arise. So Jim, tell our viewers how they can get their access to Macro Tides and getting the most recent technical review.
Email Jim Welsh Macro at Gmail. I'll send you the September macro tides, which goes into the AI stuff a little bit greater detail, discusses the stuff with the President Trump and the Federal Reserve and Lisa Cook and all that stuff and the potential implications. Yeah, Jim Welsh Macro at Gmail, and I'll be happy to send it out.
All right, Jim. Well, it's always a pleasure to catch up with you each and every week and stay up to date with everything that's moving. So I want to wish you the best of luck for tomorrow, and I want to wish our viewers best of luck for the jobs report tomorrow as well. And you might be watching this during the European hours before that jobs report, and if you are, best of luck to you.
All right, take care. Have a great week.
Thank you, Jim. You do as well. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.